Let's do this. Hi guys, and welcome back to another episode of the Enough Club. Today we are talking about investment fees. Last time we chat. No, let me start that again. I forgot to introduce Pieter. Sorry, let me start that again. Cut. Okay, let's go. Hi everybody, I am Bryan, and there is Pieter.
Hello everyone, welcome to another episode of this. I forgot what to say. It's difficult. Man.
I am Bryan Nicol.
I'm Pieter de Villiers.
He's being modest. He's not Pieter de Villiers. He's actually Dr. Pieter de Villiers. But anyway, today we're going to talk about the cost of investing. So some of you might remember in the last episode, we talked about the EAC, the effective annual cost, and we tackled the top line of that EAC, which is investment management, the cost of the funds that you're invested in. Today, we're going to tackle two more lines of that EAC table, and that is administration and other. Administration can also be called platform, or it can be called a LISP, L-I-S-P. So Pieter, why so many different names? What do they all mean? What are we paying for over here?
So when we talk about paying for a fee on a platform level, a platform is basically just the marketplace where you go and buy your fund. So you've decided, I'm going to invest in this fund. Okay, cool. So where do I now go and buy this? And we actually get different types of platforms that we can use. And I think through the evolution of financial planning and the financial industry, different platforms have existed and evolved over time. And hence why we kind of get three main ones. We get our policy-based investment platforms, our linked investment service providers, or LISPs, and our brokerage platforms. So I'll probably start with the easier one. The one that's most common in today's day and age is the LISPs, like you referred to, linked investment service provider. So these are platforms that are very easy to understand. If you look at your EAC, it will show you an admin fee, usually ranging between 0.1 to about 0.58%. That's kind of what we expect in that range. And this is the fee that we pay the platform where we invest our fund for things like managing keeping our money safe in a custodial account, facilitating debit orders, contributions, withdrawals, issuing tax certificates, all of the administration behind your money being invested. And typically, they will apply this admin fee on a tiered scale. So depending on how much you have invested with them, the fee will usually taper down. And some platforms also cap the fee that you pay at certain levels. Generally, the more money you have invested with a platform, the lower your fee will get to. And that's usually a way to also save money on investment platform fees. LISP platforms are the ones that we typically like to use because they are very flexible. You can start a debit order, you can stop it, you can add extra, you can withdraw at any time depending on the investment vehicle you use. And it's very transparent. You know what you pay for. And looking at the two other types of investment platforms, the second one we get is a policy-based investment platform. And this is kind of what existed in the past mostly. It was when a time was happening where your insurances and your investments got blended together. You bought insurances and you bought investments in the form of an insurance contract. Now, this is typically stuff like your retirement annuities and your endowments that got locked into long-term contracts, and the administration fee on those platforms look very much different. And that's usually where the other fee comes in. So Bryan, maybe elaborate on what that might look like.
Yeah, cool. No problem. So I think firstly, let's just contextualize the fees you pay for admin and what you should be paying and what you should not be paying. So you mentioned earlier on the range of 0.1 to 0.5, excluding VAT. That is a good range. If you're investing in a retirement annuity, a tax-free savings account, unit trust or ETF, something like that. You see, the more money you have with these product providers, these platforms, the lower that percentage will be. It's a mass market pricing tool. It's a sliding scale, and that makes perfect sense. So if you are paying more than 0.58, that is including VAT, more than 0.58% for an investment in terms of the administration fee, it's probably rubbish. That is what I can tell you. It's probably a rubbish product. And so, unfortunately, our market is flooded with a lot of rubbish financial products. Rubbish financial products destroy value. They destroy wealth. They actively make people poor. That is what they do. And so you get the administration fee, which could be more than that. It could be 0.8. It could be 1%. Now, you've got to realize that you get your investment return. So let's just say it's 10% a year. Your admin fee must still come off of that. You might remember from the previous episode, the investment management fee is already taken off. Those returns are net of the investment management fee, but now there's the administration fee. The administrator must get paid, and that's fair, but not get paid too much. And so now if it's above 0.58%, that's too high. And now you can do the math and say, well, let's just say the admin fee is 1% for the sake of simple math. 10% minus 1, now your net return is 9%. You can determine if that's valuable enough for you, the service they're providing or not. But I can tell you now, it's a mass market product. You should be charged a lot less. So that's the first thing. But then you get that other line item you mentioned, which is other. Other is called other because it's vague. A lot of the time, I can promise you, we don't actually know what goes on in there. However, you might, for instance, invest in an ETF, and every month you're putting money into an ETF, which isn't always advisable because ETFs can be a bit expensive to buy with brokerage costs. But sometimes those brokerage costs could be in that other row of the EAC. So now you might see 0.5% other. What they're trying to do is quantify the impact of those ad hoc brokerage costs on the return that you got. So you can say, okay, I got 10% return minus whatever percentage for admin, deduct now the other cost as well. There can be an other cost. It's not evil inherently. Sometimes people are doing a service and they need to get paid from that, but it should be low. If you see an other fee, which is percentage points, it is like 1% or more, once again, it's probably rubbish. And so what that is paying for is probably commissions, either to the advisor or to the company, or some other convoluted fee that might be concocted by the actuaries that work at that company or something. You really want these fees to be as low as possible. And the nice thing is, if you now go home and you review this fee now, and it looks like it's high, you do have options. You can find product providers out there that are much lower cost. However, there's something you have to be mindful of. If you have a contract and investment with an admin fee that is high, and it has an other fee that is high, you might encounter a hurdle. It's a barrier to exit. And so that might be a penalty. Pieter, maybe you can just outline some of the penalties that might be payable if someone wants to now, they've listened to us, they've gone and looked at the EAC of their investment and they said, oh my gosh, my admin fee is more than 0.58%. And I've got an other fee of whatever percentage points. I want to exit. I want to take this money and put it elsewhere. Sometimes there's penalties. Maybe you can elaborate on why there are those penalties, what's kind of the examples you've seen of those penalties, and how people can find out about them.
Yeah, so maybe to explain why there is a penalty in the first place. So when I mentioned insurances and investments get mixed together, and we take out let's say, retirement annuity with one of the providers, that typically an insurance provider, what is actually happening in the back end is you are taking a contract, a long-term contract on this specific product. Now, we know the rules around retirement annuities is that you can only access that from the age of 55, standard, if we now ignore the two-pot system, which means that, let's say, Pieter is a 25-year-old vet, which Pieter was, and he now wants to take out a retirement annuity, which he did. That is now locked into a 30-year contract, which he did. Now what's going to happen is, on the back end, from the provider's perspective, is Pieter is now committing a debit order. Let's say I started with 1,000 Rand a month, that I will pay every single month for 30 years, escalating every year, and I'm committing to that because, it's a contract that I'm signing. Now, what if Pieter decides to, life happens, something came across him that caused him to now take a step back and, I have to stop this investment for a while. I've got other financial priorities. As soon as Pieter wants to pause his debit order or cancel it or even decrease it, Pieter is now violating this contract he signed early on. Or if Pieter wants to move his investment to another provider, he's exiting from this long-term contract prematurely. So now there's a penalty for that, an early exit penalty that needs to be paid. Now, when you look at your EAC, you will typically find that other fee. If it's one of those policy-based insurance policies, the other fee will typically give you an idea of what that early exit penalty would be. So for example, if it's 1% and you've got 100,000 Rand invested, it might be 1,000 Rand. Now you can also request a Section 14 quote from the provider to really see what the early exit penalty fee would be in rands and cents. And what that then essentially means is if Pieter wants to move his investment to another platform, he will have to pay this fee first, and then only the balance of that will be transferred over. So where's that money going to? That is going to the insurance company to fund stuff like marketing and commission, because when said advisor sold this product to Pieter when he was a 25-year-old vet, a lot of upfront commission was paid to that advisor. That was not like a freebie from the insurance provider or like a charity case. No, that money is being recouped from Pieter's investment from day one usually for 5 to 10 years. And not only does that make the product very expensive early on, but the opportunity cost of us, of that fee that we are not earning an investment return on because we're paying it, is compounding against us. And that could really make a massive difference over a couple of decades. So early exit penalty fees are tied into these long-term insurance products, and you'll typically find that in the other component of the EAC, but you can also request a Section 14 quote. Now the question comes, if you are Pieter, and this is happening to you and you see, well, geez, I'm going to take a big knock if I now move my investment, and I look at my EAC as a whole and I see something horrid like an 8% totality fee. What do I now do, Bryan? So let's say I have to pay an early exit penalty fee, but I obviously have the option to move my investment across. What do I really look for to make sure if this is in my best interest to move, or should I just stay? Because oftentimes how these products are sold, because you'll now think for yourself, understanding this, like why would anyone ever buy this product? It's because it's marketed with all of these nice cashbacks and bonuses and stuff that you get at the end, which makes it seem nice. But you have to ask yourself who's paying for that. It's you in the early days. So let's say I have to pay a fee and I want to move across. Bryan, how do I decide? What do I look at?
Yeah, that's a good question. So you've got to do a bit of a feasibility study. Now, Pieter, let's take you, for example. Let's say you've always wanted to access your retirement funds at 55. So maybe you've got then a 25-year term until you can access that fund. So now you've given yourself an amount of years that you can work out what the cost of your current fees are. So let's just say your total fees come to 3%, and now you've got another provider that can give it to you for 1%, maybe. Now there's a 2% difference. Now you can quantify the cost of that per annum, and maybe that comes to 5,000 Rand a year, and maybe the penalty that you would pay to exit is 15,000 Rand, for example. So in 3 years with a fee saving, you can make up the penalty. So it's a simple feasibility study you can do. You talked about how the compounding effect of fees, though, can impact you. I'm going to share with you just some data from a real client case. We have many of these that we can look at. This is just one because it was just easy to do the math on this because I'm lazy. And so what you got is this client of ours. Last year we started working with them. He had many products, but one of the products was a retirement annuity. And this was an old school retirement annuity. And so we know it was old school. It was those traditional ones, the ones you talked about. We know it is because the fees were very high. So the administration and the other fee together came to 3.8%. He was contributing 4,500 per month to it. And his contributions on the product itself was set to increase at 5% a year until retirement, which for him was about, I think, 10 years away. So we looked at how much capital he would have if he carried on that way. And then we looked at how much capital he would have if he shifted that across to a provider that we would use. Now, the total fees for that investment, the after returns fees, so the administration and other, for the other product that we suggested was 0.22%. So it's effectively a 3.5% saving per year, contributing 4,500 a month, escalating at 5% a year. And it's still invested in the same kind of strategy, up to 70 or so percent equities, the same type of fund. Not the same fund exactly, but the same kind of fund. Overall, he was projected to end up with another 2.5 million Rand. That was from one retirement annuity that's only worth a couple million at the moment. changing one product provider, he did have to pay a penalty up front. That was factored into this calculation. The penalty was I think it was 10 or 12,000 Rand. He's gladly paid that, and he's moved across since. Maybe we can, I don't know, I'm just making this up on the spot now, but maybe we can do the rubbish checklist and say, if your product is rubbish, one of the ways we know is if your admin fee is probably above 0.58% inclusive of VAT. If the other line item of your EAC is like a percent or two higher, or a percent or two or more than that, if it's just a few points, basis points, that's fine. But if it's a percent or more, then it's probably rubbish. It's also probably rubbish if you want to change something about the product. You want to change the debit order. You want to stop contributing, anything like that. And there's a penalty associated with it. Red flag, it's rubbish. And so these are some of the common signs we'll see. And another way to know is, and I need to be clear about this, if it's with a life insurance company. If that money is with a life insurance company, it's probably not a great product. Now, life insurance companies often have investment platforms, administration companies connected to them. That is normally called something different. It's got a slightly different name. If your money is there, it's probably okay. But sometimes the advisor will put you with the rubbish one, and it's within the life company itself. These are kind of the easy ways to double check to make sure that you're not paying more for something than you need to. The fees can be super stealthy. You won't know until you ask about them, which is why we always say, ask about the EAC, effective annual cost. Break this down. And if you answer one or two questions that I mentioned now on the rubbish list, if you answer those yes, then it's probably worthwhile looking. And maybe there's something in the comments you can put there. If you think back to maybe your biggest investment, it's often your retirement fund or something like that. If you think to that product now, is it on a LISP, a low cost investment platform, or is it with one of the life insurers that's out there at the moment that's charging you too much? Maybe give us some insights in the comments as to where you think it is now, and if you're happy with the kind of fees that you're paying at the moment. Pieter, anything to add on that?
Yes, I think it starts with just awareness, because a lot of times people have no idea what they are paying. They just someone spoke to them at some point in their life. It said, oh, no, don't worry about it. Do a quick calculation. You need to invest so much for retirement. This nice product, it promised, and they always show you the calculations but if you start with this amount and you invest for 40 years, you get this many millions at retirement. And it sounds amazing, but it doesn't include the inflation adjusted returns, which is a topic for another day. And then they always also show you, but you also get bonuses, because you've now invested for so many years. So every couple of years, this percentage cashback or whatever term they use, it sounds amazing. It's like, you sold, it's like the best thing since sliced bread. What you have to do, and if after listening to this episode and you don't do this, then it's your fault. And whenever someone is trying to sell you an investment or help you set up anything, they have to show you the quote, and the quote has to show the effective annual cost, the full breakdown, all four of those components. Because if you see that, then you will know for sure when it's something that's in your best interest or something that's not. And there you will clearly see, because that's legalized. They have to show it. It's sort of any of these platforms within the law, they have to show the effective annual cost. But oftentimes it's not shown just because, just sign on the dotted line, get it over with and forget about it. So you don't even look at that. And you're going to see it only after many years and then regret it. So be careful of that, especially if you are younger, like a recent graduate, or you are about to graduate. These things get sold like sweeties on the playground at universities. Trust me, I've been there. I was there. I understand this, and you have to be very careful, because typically you'll open it and you'll only discover later on, and then you're going to pay a penalty fee, and it's going to be many years wasted. There is a third one that I do want us to touch on, investment platform, where it's a little bit different. It works differently. Brokerage platforms. So with these platforms, if you, for example, buy just ETFs, they don't always charge an ongoing admin fee, like a percentage of 0.5% on your total investment value. You will pay every time you buy or sell the ETF. So that could actually become cheaper over the long term, because with a list platform, 0.58%, let's use that, is on the total investment value, and that gets deducted from the investment return and paid over to the company. But if there's no admin fee on these, like typically your DIY platforms, obviously the bigger your portfolio grows, you only pay every time you buy, and it's only on that percentage that you buy. It can again be quite cost effective if you buy and hold. We did touch on this in the previous episode. And there are some international offshore platforms that also allows this. So be aware of that as well. There are some, and I'll say they are like the most, the newest generation types of platforms. So we had the policy-based, then we had the LISPs, and now we have the brokerage platforms. But it also comes with its own type of nuances to understand. We always touch on fees, saying that let's keep it as low as possible. But we also want to add that cheapest is not always best. Because if you pay the lowest fees, there's usually a reason behind it. And from my experience, what I've seen is if a company tries to cut costs as much as possible, it means they have a very lean team. And then usually what gives way first and what suffers first is customer service. So you've got a problem, you need to fix a debit order, or you want to withdraw funds. And now you have to work through some back-end system. You can't speak to a human because there is no human. It's an AI bot. You're going to get frustrated. So then you usually pay with your time. So sometimes it might make sense to pay a little bit higher admin fee, up to that 0.58%, not that nonsense of 2-3% of the policy-based ones. But up a little bit higher admin fee for a provider that is excellent in customer service, and you know that whatever problem you'll have, it will be solved, especially if you are very busy working professional and you don't have time to waste. It's not always going for the cheapest platform, but understand that there are certain guardrails that you want to move within. And starting out 0.58, but honestly, if you have a big portfolio, that fee can easily drop to 0.3, 0.2%, sometimes 0.15%, because, and it's another thing that we see is sometimes the clients that approach us, they received advice at different pockets in time, and they've got investments on this platform and that platform and that platform, and just consolidating everything to one platform already brings down the admin fee quite a lot, because now it's priced on the tiered scale on that platform, and that can cut another 0.3% on their total fees, which again, on a large portfolio, could be many tens of thousands of rands a year that they will benefit from. So if you are someone that knows, like, I've got investments all over, I can't even remember all my logins, it might make sense to consolidate as well. It is a bit of a admin schlep to transfer, especially retirement annuities. There's a lot of rules around that and a lot of paperwork, but it's usually worth the effort. Just need to understand if you might pay a penalty fee and what that might look like, and do the calculation, do the feasibility study to make sure it is in your best interest. There are some very rare instances where it might not make sense to transfer, even if the fee is very high, because you have been in that product for many decades, you have now accumulated the bonuses, and you're going to lose that. Then it might make sense to stay there. But what's most important is that you just know what to look out for to make an informed decision that's in your best interest, and not some provider or some institutions.
Yeah, I agree. There's a lot to take in there, but what stood out for me is another point that I can add to my rubbish list. And that is that if a retirement annuity or a fund that you invested in says, yes, we will throw in a bonus, there's some sort of bell and whistle. Investing is supposed to be quite boring. It's supposed to be pretty straightforward. When they start saying, do this and do that, and we'll throw money in there or whatever, like you said, Pieter, you're actually paying for it. You're paying for it now. The problem is that if they take that money away from you and give it to you later, it's not going to be equivalent, because it's not going to have compounded in growth over time. Over your loss has compounded. So yeah, that's another thing to add to the rubbish list. Bells and whistles, you pay for them. They're shiny, they're noisy, they just waste your time. And so that is, I think, a good summary of administration fees and other. In the previous episode, we talked about the investment management fees. And then in the next episode, maybe the most contentious of all, we will talk about advice fees. Not necessarily an investment fee, but for most investors in South Africa who have advisors, it is a cost of investing, is an advice fee. That's what we'll touch on next. Before we leave, anything from your side, Pieter?
Yeah, I think, again, just hoping that this series on investment fees will help you guys watching just bring some understanding of what to look out for and some clarity, so that you can pay more attention to what is serving you and what is not. and make good informed decisions that is not really going to affect you today, but many years, many decades in the future. And the industry does make it sometimes a bit difficult to really untangle all of the many different jargons. But what we're trying to do is just give you a very raw, unfiltered, straight up, objective view of what you need to look out for. And the next episode is going to be very fun. It is one that's highly debatable and where the industry is moving. So I'm very excited, and I hope to see everyone in the next episode as well.
Awesome. See you guys later. Thanks very much.
Thank you. Cheers.
Maybe we should create the rubbish list.
That one as well.
Yeah,
Freedom's
the rubbish list.
We can put it. We can put it on the website.
But it's true though.
It's like the naughty list, just the rubbish list.
The rubbish list.